Hey traders, this is Blake Morrow with Trader Summit. And for the very first time, I have Mr. Sam Burns, who is a founder of Mill Street Research. And great to see you, Sam. And thank you for being here.
Thanks, Blake. I appreciate you having me on.
No, it's great. As I was explaining to you, just meeting you ahead of time, as traders of the markets, we love to get viewpoints from folks like yourself, to have a theme that we trade off of, and to help give us overall direction of the markets. And I think, based on what I know about you and the interviews that I've seen of you, it seems like you're pretty well qualified to give us some viewpoints.
Yeah, no shortage of viewpoints. Can't guarantee their accuracy at all times, but yeah, definitely have plenty of views, and in some cases, not what everyone else is saying. So hopefully that'll be helpful.
That's definitely going to be helpful, because traders, it's what makes a market, is having two viewpoints and multiple viewpoints and navigating around them. And so let's start off with inflation. Inflation's obviously been a hot topic as of late. Everybody's discussing it. Everybody wants to know, are we headed to a deflationary environment, or is this inflationary or disinflationary pressures that we're feeling right now, is it temporary, and will it rear its ugly head, sometime in the future? What are your baseline thoughts about the inflationary environment we're in right now?
Yeah, no, you're right. It's certainly a hot topic, and I hear a lot from clients about it. And I guess in terms of the very sort of broad, big picture that you mentioned, I am not in the this is the 1970s all over again camp. I don't think that we're in for a major multi-year stretch of elevated inflation. I'm much more kind of in the camp of, I think we're going to kind of work our way back towards the kind of lower inflation environment we were in, before COVID. I think the big picture, secular kind of long-term conditions are more in line with lower inflation, slower growth, demographics, technology, all those kind of things are still kind of pushing down on inflation. And we had a big kind of supply shock and then a demand shock that came from COVID. But I think those are more like almost like a wartime thing, like you saw after World War II, or during or Korea, or things like that, where there was a sort of maybe a 2 to 3 year shock when things happened due to policy and people coming and going, and then it kind of settled down again. More so than, say, the late 60s through the early 80s, where you had this 15-year period of elevated inflation. So unless we have multiple more shocks, like big other pandemics or wars or things, I think we're probably going to drift back towards lower inflation, certainly in the US and probably globally.
Okay, well, speaking of globally, I mean, the China reopening, that hasn't done anything in your view to change your inflation outlook then?
Not really. Certainly not to the extent that maybe it would have, even say, as in 2015, 16, when they had a big stimulus, in China. I think they have less scope for it now. I think they're still facing a lot of headwinds in terms of bad debts and real estate that they've got to work their way through. And so even if they've kind of gotten through the worst of the COVID, kind of lockdown and things like that, I don't think that there's a big stimulus coming, or any kind of major, growth resurgence on a longer term basis that's going to come out of China. Because again, their demographics and things are also relatively, weakening in terms of, drivers of growth. So I think, plus the trade disputes and things they've had with the U.S. and other countries, I think we'll probably, kind of keep a lid on growth out of China. So it won't be the driver that it has been, say, for much of the last 20 years.
Yeah, I promised I wouldn't get out into a tangent, or maybe take you too far out of this, but let me just ask you about Russia, or maybe China, or maybe any type of wartime situation we might be in, or maybe get ourselves into. Would your opinions change in the event that happened? And also, I guess I want to add, do you have any thoughts on the maybe percentage of risk that might happen?
Well, yeah, and we've certainly already, seen, the effects of Russia invading Ukraine, and even there, it's probably instructive to note that, probably, third quarter or so of last year and going into the end of the year, almost everyone, an amazing amount of consensus that Europe was no doubt going into a severe recession. There was going to be an energy crisis that was going to crush the economy, and it was going to be really, really bad in Europe, for a long time and imminently. And it's turned out that that's not been the case. Things are not great in Europe, but they're much less bad than expected, and they're actually holding up. They've avoided recession, and the energy crisis is not as bad as they thought, because they planned ahead some, they managed to make things work over the winter, and they managed to kind of work around it. So the war in Ukraine is still going on, of course, but it hasn't had the impact on the European economy or the global economy that I think a lot of people feared. And the reason why oil prices went to 120, in the first and second quarter of last year, have now come basically all the way back down to where they were before Russia invaded. So in some ways, it's an indication that even when kind of the really bad things happen, the global economic impact may not be what people the worst case scenario that people are anticipating. Now, for China, whether it's Taiwan or something else that causes a problem, I don't see that as much of a risk, just because I don't think that China is in the same position Russia would be in terms of making those kind of decisions. But I'm not an expert in reading the minds of the leaders there. But I think that it's a risk that people are preparing for to some degree, and I think that probably it's not going to be a major risk imminently. I think what we've seen from Russia and Ukraine has kind of made maybe other countries less inclined to do something like that. That the response has been from the West has been more than they expected, and so that's probably made it less attractive to do something like that elsewhere.
Yeah, that makes perfect sense, and I'm glad you. And again, I want to apologize in advance for taking us in that direction. But I then that would mean if I'm going to put two and two together, and let's shift our focus maybe over to the Fed. Where do you see the terminal rate, and do you feel that because of your views of on inflation, and that we're going into probably a lower inflationary environment, I know from a consumer standpoint, that the prices have risen, they're going to stay higher, but the rate of change you think is going to completely slow down, come to a trickle, maybe even, I don't know, maybe even reverse a little bit. So in that situation, do you think that the Fed is going to be cutting rates if a recession is imminent in this year or next?
Yeah, I mean, my general view is that inflation is already slowed down a lot. The rate of change, like you mentioned, I don't think prices are going to go back on a level basis back to where they were pre-COVID, but that the rate of change has definitely slowed down. It's harder to see in the data sometimes because the year-over-year changes and the skew caused by the shelter costs and the CPI and things like that have made the kind of the inflation rate look higher than it maybe really is right now. But I think the overall picture is one of slowing inflation. And I think the Fed will, at some point, respond to that. My guess, based on what they've said recently, even as recently as yesterday or the day before, is that one more hike in May and then a pause seems to be the way they're moving toward their messaging. And I think that would make sense. My own personal opinion is they don't need to raise rates any more than they already have. I think rates are already pretty tight, and certainly relative to what the markets are pricing in for expected inflation, say over the next 5 years. If you look at the swap rates and things like that for inflation, it's around 2.5%, which is where the Fed wants inflation to be. So rates are already pretty tight relative to expected inflation, and they're probably going to look tighter relative to realized inflation, pretty soon. So I think the Fed is probably close to the end of its tightening cycle. I think if they did see some significant weakness late in the year, they might, be inclined to cut, bring rates down a little bit. I think the long end of the bond market is already pricing in quite a bit of that. So I think it's probably, I'm underweight bonds in my asset allocation because I think that the long end is already priced in some of that potential good news of the Fed maybe, easing off the brakes there later this year. But I think that probably will happen. I think things will slow down. I think they're starting to change their messaging to kind of incorporate that a little bit now as we get towards mid-year. So I think the odds that the recession starts in the next month or two is probably pretty low. By year end, possibly, but right now it looks like there's still enough momentum to keep us going for a while.
Okay, and that brings up maybe like a couple other points that I wanted to jab at you. Like let's talk a little bit about the employment situation in the U.S. It seems like we have a really tight labor market, but are we heading back to the days where we're going to see weekly jobless claims with a four handle every week, where we actually are losing jobs consistently month over month. What's your general thoughts on the U.S. jobs picture?
Yeah, no, and it's certainly been one that's been, I think, stronger than expected for a lot of people. That it's held up better in the face of rate hikes and things like that. And I think a lot of that is partly that's one of the few remaining areas really where there's still sort of supply constraint to some degree. And whereas the market for goods, things that you are manufactured, supply chains have really kind of normalized to a large degree. But labor is the part where there's still a sort of a limitation to some degree. And I think it'll be a slow move from where we've been to sort of the slower growth, lower jobs numbers. I don't expect to see the claims numbers up in above 400,000 soon. We could get there maybe late this year or early next. But I think it's going to be a slow process. I don't think it'll be a sudden thing, just because employers have spent so many months now, complaining about the lack of workers and trying to find workers, that I think it'll be a slower process to start, firing them in large numbers. And so I think there'll be some rotation, some of the, tech companies letting people go, but other companies picking them up. So far, I think that the employment market is going to hold up relatively well, and that the wages will probably also hold up relatively well, which will keep the consumer relatively firm overall, and therefore a sort of a net support for the economy. But I think the pace will kind of gradually slow down as opposed to fall off a cliff.
That's okay. And you brought up something that I'd like to touch on a little bit as far as the consumer goes, considering, being in the US, where we are definitely a consumer and services driven economy. So you expect the consumer to hold up relatively well, even in this, barring the inflationary shock that we've seen over the last year and a half. But a lot of that consumer spending, if you will, has a lot to do with the wealth effect. So when you are looking at, the biggest sources of wealth for a lot of Americans, it's their housing and their homes that they own, at least at for a lot of Americans. How do you feel about the housing market right now here in the U.S.? Because you live in the Boston area. I live in the Phoenix area, both two relatively hot markets. So I'm sure you and I are both really sensitive to that. So what are your views on the housing market currently?
Yeah, I mean, housing certainly in this area is still pretty firm, I think. And I think it's the same principle of prices have probably stopped going up to the rate they were, but I don't know if they're going to come down a lot. I think it's more a matter of kind of leveling out and maybe pulling back a little bit. My guess is that the shift in mortgage rates was so large and so sudden that it's almost kind of locked the market to some degree. Buyers don't want to buy in the sense of paying a higher mortgage rate. Sellers don't want to sell just yet because but maybe they've already locked in a low mortgage rate from a few years ago, and so it's limiting the amount of kind of turnover to some degree. But I think that the general trend in prices is probably going to be kind of flattish for a little while as people adjust to the fact that mortgage rates are significantly higher and will probably stay elevated for a while longer. I think there's still demand for housing, and the number of houses being built is probably still not high relative to the demand. But I think there's still some catch up to be done in terms of demand and supply aligning themselves, either because of the building level of building, but also because of the mortgage rates kind of forcing people to decide whether they're willing to take on a higher mortgage rate now, or wait and see if rates come back down again.
Right. It kind of put us at a standstill. But you talk about like COVID. What are your views as far as the COVID mentality or the way it shifted the mentality from the work at home culture, work in the office culture? Do you think that has permanently scarred the U.S. housing market to where you will have people looking for a bigger home with a home office, and it's changed the dynamics of home ownership here in the U.S.?
I think there will be sort of a longer term impact. It won't be as huge as we saw it immediately after COVID hit, but I think there is more now. There will be more people who are interested in working from home at least part of the time, and therefore will want the space and the requirements in their house to be able to do that. And of course, the flip side of that is commercial real estate, which is still under pressure. and facing a lot of headwinds in terms of office space that won't get filled up to the same degree. I think there's definitely companies that will want employees to come back into the office and be in person. A lot of people that they like being in person. They like going into the office and seeing colleagues and things like that. Certainly for younger people, it's much easier to make your way in the corporate world if you can be around other people in person. Whereas maybe if you have a more established job that you can do at a computer, working from home longer term is a more realistic option. So I think there's going to be a certain percentage of the workforce that kind of likes that and sticks with it. And but I think that it's probably not going to have the same impact on the housing market that it had the last couple of years. I think there'll be some balancing out of that. People still willing to live in apartments in the city or go into the office now that it's sort of safe to do so. So I think there was kind of a one-off adjustment, and now we're back to kind of a steady state where it's going to be driven more by the price of a house and the mortgage rate rather than whether you need to be near work or not.
Yeah. Okay. Well, that's some good views there as well. One last thing I wanted to talk to you about, because you briefly mentioned it, that we are probably going to be headed into a recession the second half of this year, I think is what you just said. But what is the severity of a recession that you're looking for, and like time duration, and when do you anticipate it to start, or are we already in it?
My guess, based on what the data show now, is that we're not in it yet. And it may be a little while longer before we really get into what people would really think of as a recession. And I think part of that is the difference between kind of nominal and real growth as when inflation is elevated, that nominal activity is still growing. Real activity is more muted, but it's not negative. I think, like I say, it's going to take a while to kind of work through the momentum that we had, coming out of the last couple of years, and the fact that fiscal policy is actually still relatively supportive, not like it was, of course, with all the stimulus, immediately after COVID, but it hasn't become as contractionary as it, might have been in past cycles. So just looking at something like the deficit to GDP ratio, things like that, it's still, there's still infrastructure, bills going through. There's still things like that. I don't think there'll be a lot more future going forward just because of the politics right now. But I think that the policies that are in place right now from a fiscal side are helping to balance out the tighter monetary policy, which was not the case in a lot of the previous cycles that we saw. You saw, the sort of tightening of fiscal policy happened alongside tightening of monetary policy, and that's what kept pushed the economy into recession or kept it from staying out of one. And so I think now we've got a little bit more balance, that the fiscal policy will not be a driver of recession, at least for right now. And therefore, if we do have a recession, it'll be a milder one and will take longer to get to it. So maybe it'll be next year before we really see those signs come through. But I think that the cumulative effect of all of these things will be to slow things down, which will bring inflation down. And then the question is, how does policy respond to that? Do they respond quickly and kind of try to balance things out, or do they decide, well, we really need a recession to make sure inflation doesn't come back, which would then be the more negative outcome? So I would be more inclined to tighten less and be less active on monetary policy in general, and keep the kind of volatility of the economy lower. I don't know if that will happen or not, though.
Well, speaking of volatility, you are at the Trader Summit, and we like to think about ideas and how we want to take advantage of what you feel is upcoming. I heard you say you're underweight bonds, but what are some of the best ideas you have to take advantage of what's to come in the weeks, months ahead?
Yeah, I think sort of near term, at least my views that I've been giving to clients are that be overweight equities, so that risk assets are probably going to have a tailwind for a little while longer. They've been kind of recovering for a few months now, but I think that'll probably go on. So I'm overweight stocks and underweight bonds. Your fixed income should probably be more in cash or the short end. And I think regionally, looking globally, that Europe still looks the most attractive in terms of the equity market, and even the euro, the currency, has been doing better. And again, that was more a matter of not that Europe's in fantastic shape; it's that everyone was so negative and so bearish that it's better than expected. And that's really what matters for markets, is where are things going to be less bad than expected, or better than expected. Not that they're going to have to be great in some absolute sense. I think that's been the case for Europe in particular. I think the global economy in general has held up better than expected, and that's helped, equities. Earnings, I think, will be better than expected, just because so many people are very negative on them, expecting them to fall off a cliff any day now. So all those things are kind of pushing me in the direction of keep some exposure to risk assets. It doesn't have to be, the same risk assets that you would, bought in past cycles, but I think that growth stocks, tech stocks, things like that, seem like they have some tailwinds now, and that some of the currencies like the euro, might hold up relatively well because, again, things are just not as bad as expected, and the inflation story in Europe will probably start to get better later this year as well.
Do you have any views on precious metals like gold, and any strong views there?
I think to the extent that if it looks like you think rates, and particularly real rates, will start to come back down again, that would probably be a tailwind for gold and some of the precious metals. I think they've been seeing that already to some degree, and people anticipating that when rates come down, people responding to the banking crisis or the Fed expectations, that's then translated into to gold. It's always a little hard to predict gold just because there's a lot of things that can influence it. But yeah, I think that as the trend for real rates starts to look like it's going to come back down again, that might be a tailwind for gold. Gold's had a pretty big run lately, I think, so maybe it has to pause on a tactical basis for a little while, and because some of that inflation story has already been built into it. But to the extent that the competition from cash, from interest-bearing assets starts to get reduced, or at least expected to be reduced, over the next year or so, that could be a help for gold.
Well, that's I know a lot of traders would love to hear you say that, and they'd love to see the gold continue higher. I know, like you mentioned, it's right up against its highs, but it's been an insatiable appetite for gold near term. That's for sure. So Sam, I want to ask you, I really enjoyed our conversation. How do traders find out more about what you do at Mill Street Research? And I hear you do have a newsletter. Is that correct?
Yeah. So millstreetresearch.com is the website. It has a lot of information about the work that I do. It has some sample reports. There's a blog that I update there periodically. And there is a report that I publish weekly called the Weekly Roundup, which gives my views on kind of the risk on, risk off view, primarily for equities, some stock ideas, and some macro commentary about inflation or the Fed or whatever might be going on. So that's you can subscribe straight from the website there. I also have a Twitter account that I update pretty frequently at Mill Street Research. They will just comment on what I'm saying on the macro side, as well as market activity across multiple asset classes. So if people can follow me there just to get a feel for kind of how I look at things, and then certainly reach out. There is a contact form on the website if you want to find out more.
Well, Sam, I want to say thank you very much for spending your time here at the Trader Summit. I hope this isn't your last time. I want to make sure I have you back here again here in the next couple months, and get some updated views from you about the markets and where we stand.
Oh, that'd be great. I'd love to join you again. Thanks very much for having me.
Thanks for being here. And if you guys and gals like what you heard from Sam, make sure you give him a thumbs up. Jump in the comments down below if you have anything that you wanted to, if maybe there's something that caught your eye or your attention that you want to get back to him about. And also subscribe to the channel so you don't miss any of this exclusive content. Thank you, Sam, for joining us, and we'll catch you the next time on the Trader Summit. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.